upbeat intro music fades. Welcome back, traders and investors, to the channel dedicated to uncovering unique opportunities in the market's most compelling situations. Today, we're diving deep into a fascinating small cap that has flashed brightly on our hard-to-borrow screener, Universe Pharmaceuticals Inc., ticker symbol UPC. This stock presents a perfect case study for understanding the mechanics of high cost to borrow and potential short squeeze dynamics. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show UPC logo and stock chart. Let's first get acquainted with Universe Pharmaceuticals Inc. UPC operates in the healthcare sector, specifically within drug manufacture, specialty and generic. Through its subsidiaries, UPC engages in the manufacturing, marketing, distribution, and sales of traditional Chinese medicine derivative products in China, primarily targeting common chronic health conditions in the elderly. With a current market cap of just $4 million, UPC is definitely a micro-cap play. Looking at recent price action, UPC has seen significant volatility. Today, the stock is down 5.6%. Over the last 5 trading days, it's pulled back considerably, down 50.74%. However, stretching back 30 days, UPC was up a staggering 123.5%, showing its potential for rapid moves. Volume-wise, today saw 668,100 shares traded, which is significantly lower than its 30-day average volume of 2,924,736 shares, giving us a relative volume of just 0.2x. What is cost to borrow and why it matters? Animate graphic explaining CTB. So, what does it mean when a stock is hard to borrow? In simple terms, for someone to short stock, meaning they sell shares they don't own, hoping to buy them back later at a lower price, they first need to borrow those shares. The cost to borrow CTB is the annualized fee, expressed as a percentage that short sellers must pay to borrow these shares from a lender. Think of it like an interest rate. When CTB is high, it signals that there is either very high demand to short that particular stock, or there is an extremely limited supply of shares available to borrow, or both. And yes, these fees can absolutely exceed 100% annually, sometimes much more, because the supply and demand dynamics in the borrow market are so unique. A high CTB directly eats into a short seller's potential profits, increasing the pressure on them to close their positions quickly if the trade isn't going their way. Why the stock is hard to borrow right now. Highlight key metrics on screen. Now, let's look at why Universe Pharmaceuticals Inc. UPC has landed on our hard-to-borrow screener. The numbers here are truly eye-popping. UPC currently boasts an annualized cost-to-borrow fee of 787.7%. That's an astronomical figure, indicating extreme demand or scarcity. What's more, this isn't a static number. CTB momentum shows a massive increase of plus 786 percentage points over just the last 5 trading days. This rapid acceleration in fees is a huge red flag for short sellers. And the supply? Only 3,000 shares are currently available to borrow, which is incredibly low, especially when you consider UPC estimated float as a mere 0.3 million shares. Our internal composite squeeze score, which combines these metrics with volume, price momentum, and technical setup, rates UPC at 56.2 out of 100. All these factors combined point to UPC being a prime candidate for a hard-to-borrow situation. Squeeze mechanics explained. Animate short squeeze concept. So, if a stock like UPC becomes hard to borrow, what are the potential consequences? This is where the concept of a short squeeze comes into play. A short squeeze occurs when the price of a shorted stock rapidly increases, forcing short sellers to buy back their borrowed shares to limit their losses. This forced buying, in turn, fuels the price rally even further, creating a vicious cycle for the shorts. When CTB fees are at 787.7% for UPC, those daily costs are incredibly high, putting immense financial pressure on short sellers to cover their positions. Couple that with only 3,000 shares available to borrow and a tiny estimated float of 0.3 million shares, and any significant buying pressure could quickly overwhelm the supply, driving the price up sharply. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have strong conviction in their bearish thesis and are willing to pay extraordinary fees to maintain their positions, especially after UPC's recent 50% drop over 5 days. Dilution risk check. Show SEC filings text no dilution. A critical factor to consider for any potential short squeeze candidate is dilution risk. Dilution happens when a company issues new shares, which increases the total number of shares outstanding. This can offset any buying pressure from short covering, effectively negating or weakening a squeeze thesis, even with high cost to borrow fees, because there are simply more shares to absorb the demand. For Universe Pharmaceuticals Inc., we conducted a thorough check for recent dilutive SEC filings such as -1s, -3s, or 424Bs over the last 90 days. We found no recent dilutive filings for UPC. Furthermore, there have been no recent reverse splits for UPC in our look-back window, which can also sometimes be a precursor to dilution. This low dilution risk is a positive sign for the short squeeze thesis, as it means fewer potential headwinds from new share issuance. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show UPC chart with indicators. If you're watching UPC for potential short squeeze action, there are a few key things to monitor. First, keep a close eye on the cost to borrow and the number of shares available to borrow. Any further increase in CTB or decrease in available shares would intensify the pressure. Second, look for a significant increase in trading volume, ideally above its 30-day average of 2.9 million shares, especially if it coincides with positive price action. A relative volume above 1.0x would signal increased interest. Third, watch for price stabilization or reversal from the recent 50% pullback. Strong buying momentum that pushes the price higher can be the catalyst that forces short sellers to begin covering their positions, particularly given the already high cost of borrowing. Upfront music begins to fade in. Universe Pharmaceuticals Inc. UPC presents a compelling picture with its astronomical 787.7% cost to borrow, staggering 786 percentage point increase in 5 days, and a critically low 3,000 shares available to borrow against a tiny 0.3 million share float. While these are powerful indicators of a stock that is extremely hard to borrow, remember that a squeeze is never guaranteed. Short sellers may have conviction, and even with high fees, it takes buying pressure to truly ignite a squeeze. Always conduct your own research and understand the risks involved. If you found this deep dive into UPC valuable, please hit that like button, subscribe to the channel for more unique insights into hard to borrow stocks, and let us know in the comments below what other tickers you'd like us to analyze next. Thanks for watching, and happy trading.